Hello, everyone, and welcome back to another Market Insights. I'm Jerry Hall, and here's the view from Costa Rica. Now, we've all heard about the PayPal news, and as wonderful as it is for our digital asset space to get exposure to the world outside of crypto, I'm talking about Wall Street, I'm talking about mom and pa. It's excellent. This is wonderful for awareness. However, keep in mind that this company, PayPal, all they do is facilitate a transaction. They are a middleman, or what we would call a rent taker. They sit in the middle of person A doing a transaction with entity B, and they take a fee. Well, the whole promise of crypto, and one of the wonderful things about this technology, is if I have a wallet and you have a wallet, then I just transact with you directly. I say this because long term, I don't think PayPal will be around. I think a lot of these companies will not be around. It'll be really interesting to see how this plays out. There's another element to this that I don't hear anybody talking about. And here we have a payments company taking on digital assets and giving us the ability to facilitate transactions with these digital assets. Yet the digital assets themselves that they've listed are the slowest and most expensive to transact in. So not only are fees going to be paid in the middle by the networks that are doing, these blockchain networks, but the company itself, PayPal, isn't going to do this for free. It's wonderful for exposure. I do not think it's wonderful for adoption. I could be wrong. Time will tell. But I wanted to make this video today because I think it signals something. It signals something to me, and I believe it signals something to the larger capital markets environment as a whole. When I take a look at this Forbes tweet, and they're talking about Bitcoin and its $13,000 valuation, they're talking about the percentage gain on the year, they're talking about outpaced returns leading all assets, talking about S&P and the infamous FANG members. This is excellent exposure for us in that you have a capital market structure that is at record high valuations. Value generally has always been created through growth. Well, traditionally in this country, in the United States and abroad, growth has been driven by credit, the ability to borrow money, put that money to work, whether it be in the form of expanding the reach of your company, the products that you can make available to the world, or the services that you provide. But we've seen the shift over the last 6, 7, 8, 9 years where credit, because borrowing money has been so cheap for these large entities, that they borrow money, issue a bond, somebody buys that bond, and they take the money and they buy back their own shares, forcing up the value of their company. So the value of their company isn't necessarily related to the actual value of the company as it pertains to the widgets they make or the services they provide, but using a math model of supply and demand. If a company has 1,000 shares on the open market, and those shares are going for $20 generally, and the company itself borrows money and starts buying the stocks back, it reduces the supply. And a lot of times it'll trigger demand because they'll see the valuation going up. This is straight supply and demand, order book type math. And it's worked really well. Many people have made a ton of money on the process. The purchasers have been very happy to see on paper a rate of return on their investment. If you bought Tesla 2 years ago and you're sitting on Tesla stock right now, you're like, yeah, baby, this is wonderful. Don't be so confident. The purpose of this video today is to show you several things. One, I want to illustrate that our standard capital markets are inflated, overvalued. Debt markets are so large now that expansion through debt is going to be very, very difficult. The point being, it's going to be hard to keep this train moving. Factor in COVID and all the shocks and wonderful things that come to that. Some of us are going to be in for a big letdown. Let's hope it's not you. I bring up this from Seeking Alpha. Bitcoin savings account targeting 4%. That's a very relevant number. The reason being, in debt markets, for instance, the most pristine capital on the planet, according to some, is the US Treasury bill. You buy a 10-year Treasury bill, you put your $100 in, they're going to guarantee you a rate of return of 0.25% over 3 years. 0.25% rate of return? That is horrible. Well, these Bitcoin savings account type things, this particular article is talking about Luna BTC wallets, which is just another Celsius, Cred Earn, Nexo type company. Point being, Bitcoin is starting to be recognized as a very solid collateral. And to get 4% return on your investment when the highest form of collateral, the most stable, the most reliable collateral on the planet on a 3-year note is only returning you 0.25%, this becomes an attractive alternative. And it becomes attractive in a big way really quickly. This bodes very well for the digital asset space. This tweet from Lisa is talking about credit conditions. Now, we all know, we heard so much about the Fed and the Treasury and the Fed's printing money and buying Treasury bonds, which is great for the Treasury's capital account. It's great for the Fed balance sheet. It's wonderful for these broker-dealer banks that are working with the Fed, that are padding their balance sheets and padding their reserves. But it's not wonderful for you and I who are capital constrained and need to borrow money. What happens when banks tighten their lending standards are two things. One, the cost to borrow money goes up. Two, the number of people who have access to that money goes down. And it's no different for corporates. Keep in mind that in the United States, folks, there are only 2 AAA rated credit worthy corporations, Johnson & Johnson and Microsoft. Everybody else is at much higher risk. And when you get down into the credit markets for corporates and you get below the BBB grade rating, you go into what they call the junk bond facilities. Now, investment grade credit does not pay very much. As a matter of fact, I can buy a Microsoft bond for the Microsoft Corporation, which is a AAA rated corporation, and only get 0.35% guarantee. That's horrible. return on my investment. Now you see where these 4% crypto collateralized interest bearing instruments start becoming pretty attractive, right? The other downside to this is if credit is fueled growth and credit standards are tightening, growth will slow down. Prepare yourself, folks. We are in a recession. Some may say we're entering a depression. One last slide before I get into the meat and potatoes of this thing. This is from the BIS. We are very well attuned to who these folks are. They're talking about cross-border credit to emerging markets and developing economies falling year over year for the first time in the last 4 years. So corporates are going to find it harder to borrow money. Governments are going to finding it harder to borrow money. People are finding it harder to borrow money. Even with the printing press working overtime, this is a dislocation. Pain is sure to follow. However, this bodes very well for the digital asset space, and I'll tell you why. As access to capital, cheap capital, very affordable credit terms and means, becomes harder and harder, people are going to seek gain or yield from other vehicles. The PayPal thing, although I don't think is a big deal in it by itself, just the sheer acknowledgement and exposure it gives digital assets to a larger audience, that is wonderful. Companies like MicroStrategies and Square, and there's several others now that have been publicly announced, taking corporate balance sheet cash and turning it into Bitcoin. This is big. This is huge. Now, here's the thing we have to remember. With pensions and endowments and national sovereign funds, etc., they are risk adverse. They're not risk on. And as the digital asset space, specifically pertaining to Bitcoin, its market cap grows, the larger it grows, the less of a risk it is. So there are many entities around the world who are and have been waiting. One of the wonderful things about my channel is that I've had the opportunity to speak with some folks that are in that game. They play in the capital market structure. I'm hearkening back to an interview I did with Raoul Pal, and I remember talking to Raoul, and he talked about there are family offices, endowments, pensions, and sovereign wealth funds that are positioning themselves to enter the digital asset space. Now, my common everyday thinking is, well, why weren't they buying at 10,000? If they know they're going to get in, why wouldn't they buy at 10,000? The risk that it presents at 10,000 is actually greater than the risk it presents at 14,000. There are some that are waiting for it to reach its all-time high again. It is not intuitive for me to think like that. But if I understand and trust the words that I'm hearing from these folks, there's an element of it that makes sense. The larger this market cap is, the less volatile it will be. The more participants, i.e. the network effect, will kick in and it will start to stabilize. For you and I to see a 5 or 6, even 8% gain in a day disappear the next day, that's normal in crypto to you and I. Got to remember, the big boys, they don't like those kind of swings. Traders do, but not investors. As this market cap grows, it presents less and less of a risk, even though they're buying the asset at a higher price. This is very, very interesting. Because what it tells me in a world where credit's getting harder, growth is slowing down, actually in some cases come to a complete stop. And here we have this new emerging asset class presenting returns unlike anything else in any of the other capital markets. Two things happen. One, this digital asset space is going to grow, which is great for us that are invested in it. But many of you have retained jobs, or up until recently were in a job, and you contributed to a 401k and you contributed to IRAs. And those particular vehicles have traditional assets in them that are at all-time record high valuations. Don't get caught with your pants down, folks. Find out what you have. Find out if you can self-direct any of these things. Are you in mutual funds that are gobbling up 3.5% a year? Find out what you have. Investigate and find out what you can do with what you have. The smart money is going to exit near the top and get into other assets that are asymmetric to what they're in currently. If you're in Tesla now, well, good for you. You've made some money over the last year and a half. But what happens if Tesla corrects 50%? Are you still profitable? Or would you be better served moving your retirement assets into something that what we would consider today to be volatile and depressed, that has this huge upside? Or you just wait it out in your traditional plans? I can't answer that question for you in a video, but what I can do is ask you to think about it. Think about what you got. Look at what your options are. Do you roll your traditional 401k into a Roth IRA where you can self-direct what assets you're investing in? Gold, silver, and digital assets, probably the top 10, 12, will do very well over the long term for the next 3 to 5, 10 years. The existing S&P, NASDAQ, etc., I don't know. All the numbers I'm hearing is that traditional equities over the next 10 years have a negative expected rate of return. Food for thought, folks. I want to let you know I very much appreciate you tuning in. Tonight's live stream, this is October 23rd, so tonight's live stream is going to feature a couple of the guys from iTrustCapital. We're going to talk about migration of your 401ks and IRAs into a self-directed account. What that looks like, what it costs. We're going to talk about the pros and the cons, not just the fluff. So tune in tonight. I look forward to seeing you. Bring your questions. Bring a great attitude, because although the world is in an economic recession, some would say a depression, there are opportunities, and it's important to continue to educate ourselves so that we can maximize ourselves with those opportunities. Well, that's enough from me. Thanks for tuning in. I appreciate your support. And until next time, Pura Vida.